Okay, hello everyone. Welcome back to another Breaking Into Data event. I'm Aaron Falus, for those of you who don't know me, founder of Promotable and your host for this evening's event. Before we get started and hand it off to Justin, just a couple of quick announcements. Please, for those of you who, if there are any people that you see who are still in the lounge or that you know, feel free to tell them to come in. Also, we'll be recording this session. It'll be available on our YouTube channel, so feel free to go check that out afterwards as well. And so no need to take screenshots or what have you, but you're more than welcome to if you would like to. That said, so Promotable, who are we? So we're a professional development platform that teaches data analytics skills required to do your best work now and become more promotable in the future through industry-created, expert-led, and mentor-driven hands-on training. In these events, we invite data experts and business leaders to share their expertise so you can network, learn actionable tips and techniques, move your career forward. We also offer virtual live online training programs for those of you who want to take the next step in becoming promotable. Our first course, our most popular course, is a data analytics for business course. We teach things like SQL, Tableau. It's for someone who is a business professional. You might be in marketing or product or finance. You want to take that to the next level so you are able to find those insights, make those data-driven decisions. That's a 5-hour-a-week course, all taught by practitioners, just like Justin. Our second course is our new Data Science Accelerator. So for those folks who want to really dive in, make that career change, become a data scientist, we have a 15-week program. It's full-time, immersive, in partnership with 1871 in Chicago. So it's an income share agreement-based program. It's live online, full-time, and closes the gap between learning and that first job, but really just going beyond that certificate, right? We start with top-notch instructors. Our lead is director of data science from Anthem. So current data scientists, hiring managers at top companies, and second, we have added a team of mentors, not just one-on-one. We have a whole board of mentors, really to get those insights that you can't really get from anywhere else, right? Only from someone who's actually been there. And lastly, we, of course, connect all of our students with our industry partners. So instead of walking away with a passion project, you've actually done something for real with either a growth stage or a Fortune 500 type company. And of course, it's all backed by our job guarantee. So for folks who are interested, feel free to come say hello. Feel free to come say hello anyway. That said, if you'd like to learn more, go to promotable.io. And we will be, I'll be hanging out after the talk as well. So feel free to say hello. Last thing, if you have questions, please put them not in the chat. There's a question feature, or go ahead and raise your hand. We'll be able to invite you to the stage, and so then everyone can hear your question and we can dive in. So save those for right after Justin finishes, and then we'll have a good lively discussion. And of course, we left the lounge open for you. So after the talk, if you guys want to hang out, meet each other, network, I think there's tables of like 8. We have several of those. Feel free to come and hang out, because I think we all have that Zoom fatigue and we're all ready to meet new people and all that. So without further ado, introducing Justin Sheets. So he's the co-founder and co-portfolio manager for Vitruvian Capital. And also, I know, Justin, you've you've worked at all the big names, at least just a couple that I saw. I think you're at, I know it was Barclays, Blackrock, Matthews, right? I think the Asia-focused company. And now you guys have started your own shop, which is really exciting. So hand it off to you and take it away.
Sure. Thank you very much, Aaron. I'm very glad to talk to you guys. I think that in the data world, I've always found that it was great to be looking into data in the quantitative investing world. I started a long time ago in a more, I guess, traditional finance in the stock market, and then slowly became more quantitative. But so I have a few prepared words in the deck here. Hopefully some interesting examples for you that I think they're very timely. I have something for GameStop. I think everyone will love that one. But here I was going to head right into it. So here's what I was going to go through. It's pretty simple. I have a great example, some of my background, some of the kinds of financial data you can go through in the various components of the finance world. basically what is a quant, and some of the quant models that we actually look at to pick stocks. And then, of course, what kind of technology we use, and maybe a few things I can say about careers to be looking into. So the first thing I thought it was an interesting example to show you guys. So obviously everyone's familiar with GameStop. If you're not, basically there was a huge bubble in the shares. Essentially, what happened is there were a few companies that were very significantly short the shares, a few hedge funds that were significantly short the shares, and people on one of the Reddit boards noted that there was a significant short, noted that the shares were pretty illiquid, and were able to get all of their friends to buy, and basically got the stock to move quickly. A lot of that was sort of based on the fact that they used options to do that, but nonetheless. So the big event at least for me, and what we saw in our investing, is that not only were these two, I guess we heard one or two large hedge funds that were hit, but even if you were not short the stock, we also actually significantly lost performance every day that this stock rose, because of the fact that we didn't own the stock. We actually hated the stock. Our ranking models basically found it to be awful. We thought, and as I have a note here, it had poor financials, high short interest, and we thought it was overvalued. And we thought the stock was actually worth $13. It also had poor sentiment on some of its recent company conference calls. So the examples I have for you, if you notice the little picture I put together, so that's basically the Wall Street bruh, I guess, for nothing better to say. And it's basically, it's a simple word frequency that looks at one of the, it was one day, it was February 5th, and it was the daily discussion. And you can see that the most frequent words used there were GME, which is the stock ticker for GameStop, and AMC, the stock ticker for AMC. And you can see that's a pretty major. Those two names were pretty important. You can also see things like Moon, Rocket, halted, because given the fact that the stock moved significantly over that time, it was actually halted multiple times during those days. So that's I thought that was pretty interesting. One of the things that all these hedge funds will be doing after being hurt so badly is they will be monitoring those Reddit websites. They will using I have noted here some packages that you can very quickly jump in and look at all the words in on those websites, and then you can. Here's just a simple thing: frequency. It just basically takes, and it's very simple. It's probably 10 minutes of work that would take the frequency of the words, the most used words, basically, in those subreddit boards. You get actually a little bit more sophisticated by saying, well, what are the sentiment of those stocks? So you could actually do more sophisticated models. I've noted here packages, Python packages, NLTK, Vader, Spacey, that you would be able to do some more significant work. And I can guarantee you those hedge funds will do that more significant work to create sort of a trading plan around these stocks. If you note on the top graph, so this is basically the fees that you would have to pay to borrow stock for the last 2 or 3 years. You can notice that the current time actually was not, the last few data points in January and February are actually not the highest, but obviously spiked up after some period of time. So you can see that many of these hedge funds had to pay a significant higher amount than they would have normally. Generally, that would have led most hedge funds to have not gone into the idea, but they were holding it, and they wanted to keep the bet. Obviously, that hurt significantly. going forward, what they're going to be doing is any significant bets they want, they're going to look through some of the retail trading. Not only retail trading in this, I guess, sort of a sentiment way, but they'll probably also buy the data from some of the retail brokerages. Some of the retail brokerages will sell sort of like anonymized data for hedge funds. So definitely, they'll probably be looking at it in multiple ways. So I guess that was kind of an intro to how kinds of things that we might look at in our investment world as a intro example. But here's a quick, I guess, rundown of me and my background. So I kind of started sort of in the, I guess, a non-quant world. Granted, I had some programming in high school, and I guess I've always been interested, but I kind of held that back. I was an international studies major at a small school in Maine. And, basically it was government, history, econ, nothing really quanty. And then, I started in New York City. I worked for some data firms. We're not using much more than Excel. Nothing special. And then after that, I got a job, which kind of, for me, kind of started, I guess, a significant portion of my career. I started to work at a company called Barra Rogers Casey. And Barra, if you're not familiar, is now owned by a company called MSCI Barra. And it's essentially one of the major index firms. So they make global indexes that people can invest in. And many companies buy those indexes to create index funds. So I worked with this firm, and it had, it used a lot of software that Barra had created that was risk models. Basically, we'd use those risk models to analyze some of the portfolios that some of the big institutional investors would use, and we could break the risks that those portfolios took into various things like value, growth, small cap, large cap, and it would be a nice way of looking at the risks in aggregate that investment managers were taking. Eventually, this led me into working for one of the biggest index firms in the world, which was called Barclays Global Investors at the time. And now that's called Blackrock. I'm pretty sure everyone's probably heard of Blackrock in the investment world. I believe the numbers I heard were I think it was actually $8 trillion. Pretty significant. Those are the amounts of assets under management. And that's broken up into, big institutions like, CalPERS, which is the public retirement system for California, the Teachers Public Retirement System, and many other large institutional investors, as well as many individuals who own ETFs. So that's a fairly significant firm. Actually, and unfortunately, I was laid off from that firm after 12 years. Our group was, having some trouble, but it was a great 12 years, and I wish I had more education at the time. So while I had been learning some SAS statistical software and started to do a lot more programming, I wasn't able to do it full time, but it was definitely enjoyable. So after that, I started actually a computational finance program from the University of Washington. And I found that through actually Coursera. They had a great intro class, and I was able to discover that it was a full-time program and joined in. After that, I went to Union Bank, and there was a small money management firm that they had, and it was a quant firm. So I was able to do some of the research that I'd always wanted to do. And unfortunately, we were trying to do a spin-off of our firm, and that didn't work. So eventually, my former boss and I started our own company. So now it's, my former boss and I, we're basically co-portfolio managers, and we've created a full, investment management system where, on a daily basis, we take tons of financial data. put it together with some of our models that we've researched, and could literally trade every day with a portfolio of stocks. We're typically what they call small caps, so we typically are more interested in names that are much smaller than your Teslas, your Apples. Actually, to be honest, more in the GameStop world. That's more of the place we play. So that's actually me to I guess where I am right now. I happen to totally enjoy the how data and investments really put together. So that's what I've always been interested in, and I wish I'd known it a long time ago. But I'm glad I'm here now. So one of the just one second. All right, so I wanted to go into, some of you might be familiar with the data that's available for the finance world. It's pretty immense, petabytes and petabytes, I've heard. But it's essentially broken up into, I would say, sort of market data, financial data, and other kinds of data that are related to individual stocks. So, market data, I would think of like the pricing data and volume data for all equities, options, and some of the derivative contracts that exist. I would also consider, the stock and bond index data. That would be kind of the compositions of those indexes by S&P, Russell, others you may have heard of. And the other interesting market data, and it relates back to the GameStop, is the short interest data. So this would be data that all the exchanges put together on a monthly basis that tells the aggregate short sales for every company. And it's mostly available in the United States. It gets a little harder to get in the international world. So in the financial data, I would think, obviously all of the financial statements that the companies put together. Also, any quarterly conference calls, which I will get to actually talk about a little later. I would also include analyst reporting in that. That would be, any of the estimates that the industry analysts who follow those stocks publish. Their companies would publish this data. Other interesting information is also share ownership. That means basically what institutions hold this stock. So in the example of GameStop, they showed that how much the institutions held, how much that was short sold. It was short sailed in there, and that kind of led to the GameStop bubble. Other data that is pretty interesting are risk data. I mentioned Barra, and there are a few other companies that also provide this kind of risk model view. They also do it for equities, bonds, although bonds are actually a little tougher to analyze. Other significant data are, what they call ESG data. That would be environmental, social, and governance data. So this would be mostly company-reported data that every company would kind of go through, the kind of carbon footprint it has, and other significant things that people would be interested in talking about. The data for ESG right now is actually very big, both analyzing the data, collecting the data, and creating new rankings. We're as a firm, we're pinged constantly by folks who want to sell this kind of data to us to see if we'll have a subscription or something like that. So that's a big I guess investment data point right now. Other interesting things are point of sale data. So some vendors will give anonymized data for like Visa and MasterCard will give anonymized data. How much people pay, how much people buy at Walmart, or whatever their Amazon purchases are. And this kind of data is investment folks, especially quants like me, would potentially put models together to see how the stock is doing. So we might actually, it's almost like I would call it a channel check, so that we would be able to say, oh, there's more significant purchases this quarter than say last quarter, or this quarter versus a year ago, and that might put a higher ranking on a stock. You also have shipping container data. For that same point, you'd be able to see if that company is shipping more product, on container ships than it was last quarter. And you have things like patent data, real estate properties, and then bank data too. And all of these are, I would say some of the major points. There's by no means these are kind of broad topics. There's tons of data that's available. But these are all, interesting financial data points that, and each of these data points and groups have companies that sell it, and need people to analyze it, and sell it to other, quants or other people who might need it. So it's a fairly large I guess, area for potential job opportunities. I guess a quick, what is a quant? Historically, a quant was some kind of, it was almost before they called data science. It was the thing. It was basically, you found a lot of PhDs in either computer science. You might find accounting PhDs, operations research, astrophysics. Some of the head research folks from Barclays Global Investors, one had a PhD in operations research, and the other one had a PhD in astrophysics. It kind of takes different ways of getting there. Sometimes it's a science background, and then they learn investments. Or sometimes it's an MBA person who's able to program. In my case, I do have a CFA. I guess for me, it's, kind of the person with domain knowledge, in this case, financial knowledge, wanting to go beyond Excel. When you before Excel didn't have, you couldn't go too far down the rows. I think 65,000 rows was more than you could manage. At that point, you had to jump off to something else. So it definitely you kind of had to step up your game to compete. And it basically, in the investment world, you kind of have a view of there's multiple kinds of investors. You have more quantitative investors, and you have more fundamental investors. The traditional mutual fund investor you hear about is typically more fundamental. So that means they will go out and talk to the company management. They'll see how they're doing. They will look at the financial statements. They will try to come up with a discounted cash flow model, and then try to project the performance of the stock, 20 years in the future. So quants, and so basically I consider a quant someone who uses that same sort of financial knowledge, but uses it across multiple names. We consider it very scalable, what we try to do. Where your typical fundamental manager will look at, I think, maybe they can look at 20 to 30 stocks per person. Where, quants, we can look at thousands and thousands of names. Our models look at essentially 3,000 stocks a day. If we have more data, our models will change. So that's just US. So internationally, you could consider 25 to 40,000 names. So we could actually create a model that would rank 40,000 names a day. But I guess a typical definition would be quants use financial theory and the scientific method to develop a more scalable idea. And we use all kinds of technology to be able to gather the data, analyze it, and see if it would actually fit and improve our investment process. And then basically once we're finished, we create models that would be able to rank, as I said, up to 40,000 stocks a day. So I guess a quick idea of some of the models that we might have created. So these are examples. We have, I guess, we have one or two of the models here, but they're a little bit more advanced. So going back to the short interest, which I mentioned, so you can basically create a model where if you collect that short interest data that I mentioned and you rank it across all the stocks. So in this case, you would actually want to, the higher the short interest, you would want to avoid that stock. The lower short interest is something that you would actually want to purchase. And the idea is that big hedge funds generally have, they've generally done a lot of research, potentially more research than most people, and they have to have conviction. To short sell the stock, you have to actually, I showed you that short fee rebate. Generally, you have to actually pay some money to, the broker to borrow the shares. So you have to have a conviction that the stock is going down. Not only that, given the asymmetric kind of idea of short sale, you could potentially, lose infinite amount of money because the stock could go to the moon, but all you can do is go to zero. So you have to have significant conviction. So a model created by this is actually done really well over time. It's been, one of the better performing models for a long time, except for this year. And that's been very specific because of the subreddit, Wall Street Bets, and the actions from some of these folks by them sort of pushing the theory that, basically pushing, an alternate investment view that was kind of not fundamentally based, created a significant market bubble in these shares, which we're seeing now that, the share price is, I think, 40 something, 50 something. It's getting closer to where it should be. Other models that, people have looked at are sort of valuation models. You may have heard of price to earnings models or price to book models. Well, we actually kind of look at it differently. We actually consider it book to price or earnings to price. We're actually interested in how much of financial, how much, say, earnings per share we could get for $1. We kind of look at it a little different. Other data models, which are something that I'm actually investigating, as we speak. I have created some models that essentially take that Wall Street Bets example and look at the words that are used in a industry conference call. So every quarter, the companies provide sort of a discussion of how their stock has gone, the company's business prospects. And I've created models that look through all the words of that transcript and rank certain things that we find important. And this, unfortunately, this is not new. People have actually been doing it for a little while, but it still provides value. Many times it's because the fact that we're doing it across thousands of stocks, whereas some of the investors can only, an individual investor I mentioned, or an analyst, fundamental analyst, has to listen to 20 to 30 of these calls that every quarter. I don't have to listen to it. I can just set it up on my machine and run it. And obviously, more advanced firms are using significant multiprocessing, Spark, and a few other ways where they can just rip through everything pretty quickly. Mine's pretty quick too. So it's definitely an interesting point. And for some of these transcripts for conference calls, and because of the data, many people are looking into some of the other database, I guess, non-relational databases like NoSQL. I think there are names like CouchDB and MongoDB. Some of the next things that people are looking at, this is sort of a big data race. They're looking at machine learning in the financial world, being able to potentially figure out other ways to rank stocks using machine learning concepts. Many times when we hear machine learning, at least in the quant world, we kind of give it a little bit of discount, because many times it's just really statistical analysis from before. It's just the models have changed a little bit, so maybe it's picking up some differences. But we kind of give it a little bit of kind of shake our heads. But there is some interesting work out there. You can also do some of the natural language processing through the 10K documents, through the financial statements that companies put on a quarterly basis and a yearly basis. You could also look at Twitter. People have been doing Twitter analysis just like the subreddit data. And then retail flow, looking at sort of the anonymized data from brokerage firms. And then, of course, I mentioned the environmental, social, and governance data that has been pretty prominent in the last 2 or 3 years. So some of the technology that certainly that I have used and you find many times in the quant world, SAS is becoming, I guess, less used, but it was something I used a while ago. R is obviously very big. MATLAB, Octave, those are Octave is, I think, a sort of a more public version of MATLAB. One thing I noticed about R is I think R is great. It's great for statistical analysis, specifically, the data table. But it's not that fast. So if you're looking at, I guess the way I call it is Python is a glue language. It puts together everything you want. And I'd say the statistics is getting there, but maybe not quite there. I think there are a lot more R packages for statistical analysis than Python. But Python's roaring away, and people are developing things left and right. So I think it's amazing. I'm using Python now. I'd started to use R at Blackrock, but my program from the University of Washington was solely in R. So I was basically programming, I guess 200 or 300 lines, a day for that course. So I learned R pretty well, and now kind of switched over to Python. The databases we use, Microsoft SQL, MySQL, MongoDB. Now there are other databases for, I think I mentioned that are, it's basically the pricing data and volume data, and it's tick data. It's basically data that comes for, imagine, every stock, every millisecond there's a trade, and there's almost specific databases, KDB, and I think K is another kind. And that's a big business too, looking into all the data for, specific stock pricing data. And then, there's always cloud-based services. Our company, we have, I guess, a main server, physical server, for some of the data and programs we haven't quite figured out how to put up on the cloud, but the rest of our databases are all on AWS. And yeah, essentially it's an AWS database system. We have, I think it's a terabyte and a half of data so far up there. Yeah, it's been great, especially working from home. It works out pretty well. I guess some words on career paths. Obviously, my sort of work path has been fairly roundabout, but things you can consider. Obviously, directly into some of the quant firms out there, BlackRock. There are other big hedge funds out there. I think it's like ManHL. Huge firms out there. If you had time, we could probably go through some that you might be interested in. But on the, I guess, pure data side, there are risk data firms which also might be interesting. These firms have they basically, as I mentioned, they create portfolio systems which look at basically the different kinds of risks of the portfolio, and so they basically go out and talk to their clients. We're a client of a company called Axioma, and we have a significant investment with them, They basically provide all the data all the risk data we use. They help with some of the optimizations that we would use every time we want to trade. Basically, these are the kinds of companies that you would want to consider, working for. Not only do they have some people who are consultants who go out and talk to clients and help them work through some of their investment problems. But we find typically what happens is that you might work there for a while and then join a firm, join one of these big hedge funds or big investment firms. So, that's a pretty interesting way of getting there through some of these data. And you can also consider that through some of the data providers I mentioned. Huge companies that are invested that, provide financial data, FactSet, Bloomberg, and S&P Capital IQ. The idea would be, working for one of these firms, working in the data management, working in, a sort of a consultant basis, and then you could potentially move off to one of your clients. If you please one of the clients, you create great relationships, and you might consider being able to move off to them. The other sort of data science sort of way is many of the fundamental firms, these firms that have always sort of traditionally done the non-quant way, are now looking into data science. They realize that they're kind of on the slow end of things, the buggy whip, and may consider ways to improve their investment view. I guess I would be worried about that. You might learn a lot. I would be worried about that because, I don't think they would see you as an investment person. But, we could, if you had questions later on, I could discuss, how that would work. But these are some ideas of sort of career paths that, sort of in the financial world and in the sort of data science world. That's, I guess, all the prepared remarks I had. If you had any questions, we can discuss those later.
Awesome. We've got a couple already come in, but for anyone who wants to, I'll moderate these questions. If you'd like to go ahead and raise your hand, I can invite you to the stage, and you can actually ask Justin your question yourself. We'll start with Matt's question down here. He was asking, going back to that slide, Justin, you had with the three data groups, market, financial, or other. Which has most frequently yielded a positive alpha for your fund?
So this is interesting, and so market data, I guess they've almost gone through evolution. So market data is like the beginning. Everything starts with market data, and actually this is how I consider how Bitcoin is going through now. All you have is price and volume, and that's the market data. That while some firms that are like you hear them called high frequency trading firms, that's like all the kinds of things they look at. It's pretty hard to find data. It's pretty hard to get alpha from that. That everyone has done it. There are huge firms that are have tons of people, as I mentioned, looking into tick data using those big databases. It's basically impossible to get that alpha from there. The financial data, even there, it's kind of hard now to make alpha on. Even on a quantitative basis where you're looking at thousands of names, BlackRock is doing this too and has been using these models for 20. I'm sorry. So the BlackRock and the group that I worked for was basically the preeminent quant group. And some of the funds that they started are from 1985 and used some of these basic ideas in 1985. And in maybe 2000, they were using some, accounting data that was pretty impressive. The models have done really well. The unfortunate thing is the other category is where you have to go down to get alpha. The risk data sort of helps you not lose alpha or not lose performance. But people are investigating environmental, social, governance, and we're actually doing that too. Some of the some of the things we've been working on to potentially get clients is to figure out how to create a portfolio that at the very least, we wouldn't lose any money on in a performance basis, and hopefully be able to gain something on. Some of these, like patent data, shipping container data, the real estate concepts. This is you have to go further down the line of industry specific data now. In the banking and real estate, it's almost what you need to have. In this case, I guess my ideas were that knowing the specific, for real estate firms, knowing where they have their portfolios and what might affect the real estate in that specific part of the country. So you sort of have like a model that for each stock, it says, the Northeast is not doing very well, and majority of their portfolio is in the Northeast. Well, maybe I wouldn't want to buy that stock. I'd want to buy something where something's changed. So the answer short is, you really have to dig deep now for finding alpha, and you have to go for data that no one else is looking at, which is impossible.
Got it.
All right.
Hey, Justin, thanks. This is Matt, the person who asked the question. Thanks for spending time with us. This is great. Given that, what role do you see for the sell side and fundamental analysts as data science becomes more and more integral to investment processes? I'm actually one of those fundamental analysts who I saw data science coming and wanted to get away from Excel just like you did. Did you get the sense that there's any value in probing these other data in a more granular way that the investment community, the buy-side investment community can't, or I just don't have the time for, to keep a fundamental research business value proposition intact? Does it seem like there's a there?
I mean, there is a there. So the reason, so the fundamental analysts do know the stocks better than I do. The individual stocks, those 30 or 40 stocks, 50, maybe 100 if you're like brilliant.
Yeah.
They know them much better than I do.
Right.
I know specific pieces about them. I know, that they fit into a certain category. I know all these models I'm talking about, you basically create sort of I guess a characteristic stock that I want to buy, right? Mm-hmm. I don't care what that stock is. Mm-hmm. I care that there's something that fits this idea of a good stock. The fundamental analyst says, oh, well, great, this stock is, they kind of many times get wed to it. I don't really care what it is. I might have to care to talk to somebody else about it, but I don't really care what it is, right? So there is still use for the fundamental analysts. And of course, we use the analyst data. We use earnings surprise and or the EPS numbers that the analysts put out, price targets. We use them, but we use them on the thousands and thousands of stock basis, not the 30 or 40 names. So there is a purpose. We'll pay for it. Somebody will pay for the data.
Yeah, it's just that it seems like the role of the sell side is changed dramatically after MiFID II, where it's. There's got to be a more
before then, sir.
It did. Yeah, exactly. And there's got to be some tangible value in the research function. And I'll just say it as a former sell-sider, it seemed like that was waning for a long time. But now that there's some actionable, operationally defined data that can be probed, it seems like there's value there. But I just wanted to get a buy-sider's opinion of that.
Yeah, I mean, there's going to be the traditional view still. Occasionally, I need to look at some of the analysts' things to see if, there's something I missed. At Blackrock, they will invite industry analysts all the time. They don't care what stock they're flogging; they care how they think. We want to know how you value the stock. Why do you value it that way? We don't actually care that you like Tesla. We care how you got there.
Right.
Can we systematize what you're talking about, right?
Yeah. Can we take your idea and then automate it?
Yeah. I mean, is there something that we can do on a more systematic basis? And I guess one of the key things, I mentioned we're doing across thousands of names. The bets that we're making are very small generally. We're not buying 10 stocks. Some of the models, some of the quant hedge funds own thousands of names, and all they care about is just a little piece of everyone. No home runs, just constant and consistent.
Yeah.
Right.
Yeah. Okay, cool, Matt. I'm gonna go ahead and call
Thanks, Justin.
Yeah, you're
next
welcome.
guy here. And oops. Okay, so Alex asked, are you using any graph-based databases, or have you experimented with those at all?
Not really. We while we do try to keep up to new things, there's only two of us.
Yeah.
So our next technology, I think, would be more of looking at Spark. Some of the more I guess more parallel kind of views, parallel processing kind of things.
Yep.
But no, we haven't really investigated that.
Makes sense. Next question we have from Mark. He asked, what are some of the more interesting alternative market data providers? There's a credit card, satellite images, anything else that you think are really interesting, and are those like particularly expensive?
They want an arm and a leg now. They want a lot of money for these things. So there's a company called the Eagle Alpha that are trying to sell. They're basically trying to be kind of like a warehouse of these more esoteric data sets. They come to us for new and random things. What did I see recently? Well, I guess the credit card stuff is still pretty interesting. Although BlackRock had done it like 20 years ago, or 10 years ago, let's call it. The problem is there's just a lot of data, and way back when you had difficulty connecting data to what you wanted. So that's like the biggest problem with some of these more esoteric data sets is, first of all, the providers don't think like a quant and didn't collect the right kind of data in history. We need the data so that it existed as it was way back when, and that we can connect it to a certain stock as the stock was way back when. Some companies have changed multiple times, and we have to know where the data they're talking about.
Yeah. Well, yeah, and then also you have, when you collect more, just because you have more doesn't make it necessarily better. You're just using more compute resources.
Well, if it adds value at the end, if once the biggest headache you'll talk to any financial quant is connecting the data to a stock at a point in time, as I mentioned. That's like the hardest thing in the world, and the investment firms don't want you to do that. As a firm on shoestring budget, if you can't pay, you out of the gate you need to pay some of the exchanges $20 or $30, maybe even $100,000 to really do it well. Jeez. To get the financial, basically it's basically a symbol. You basically need to be able to connect a symbol, a CDAL, QSIP. A ticker doesn't cut it. You can't use Yahoo tickers. That's not going to help you.
Yeah, Yahoo ticker was delayed by 25 minutes. Yeah, it's not going to get.
Well, no. Never mind that. That's the least of your problems. The key is that ticker could change over time.
Yeah.
And the company, the tickers are reusable, and you would connect wrong data.
Yeah, gotcha. Right? Yeah. Then you totally screwed up. Yeah. Then you. That's like the worst part. Yeah. That's like
that's like A.
Yeah. Well, it's like we have I see a lot less on the finance side, but people who go through they go down into the sexy tools and they really want to talk about that and use all the fancy stuff, and then you realize they asked the wrong question or they connected the wrong thing and feeding the wrong data, and then they wasted all this time with something totally wrong. Mark also had a quick follow-up. He asked if you still interact with BlackRock Aladdin in any way.
No. That was becoming, as I was leaving, that kind of that is another basically good job target. any of obviously the fintech companies and the BlackRock Aladdin, I think they call it BlackRock Solutions. That's a big business. That's all data, and they're trying to get people, other big investment management firms to use Aladdin, which actually incorporates some of these risk data providers that I mentioned in here. That's a big business, and working for them, that's I think a significant career.
Yeah, well, that's a rabbit hole that I could definitely go down. I mean, I think the business is selling data to financial firms. Think like Refinitiv, right? Getting sold.
Yep. That's another name. Sorry. Yeah.
I'm a nerd, so like these kinds of things, I'm like, it's such a huge business. Everyone wants to take Michael Bloomberg's money.
And they're selling, they're selling these models too. They're both S&P and Refinitiv have a few quants on hand to build these models to quote do the sell side research that Matt was discussing.
Yeah, no, that makes sense. Last question we have from Warren. He wants to make sure I understood you correctly. Earlier, I think you mentioned that it's hard to derive value from or you make accurate predictions from just market data alone.
Yeah, I mean, I guess, yeah. I mean, flat out. Everyone has this data. There are big companies whose sole job it is to do this. Making the market, making money on the price data, guessing, the analyst who's using, technical, that's a tough business. I could never see that. I'm not even sure how.
Yeah.
And that's before you get on a quant basis, looking at thousands and thousands millions of records. It's everyone's doing it and has been doing it. I can't see how you could do that.
You're not going to do it and be different, that's for sure.
I guess the key is be different.
Yeah. Because you're not going to be getting any alpha if you're doing the exact same thing as everyone else.
Yeah. And I guess the key is because if you're trying to do it by yourself, you're not going to have the data that they are. You're not going to, you've already have to pay up for real-time data. Yeah. Plus, they're looking at tick data, that millisecond by millisecond timestamp data that I mentioned.
Yeah, absolutely.
So you're at a disadvantage if you're trying to go against the big folks on that range.
Yeah. Okay, no problem. Warren, handing you the mic right now.
Hey guys.
Hey.
I just want to maybe add a little bit of context to the question. The reason that I asked the question, and the reason that I was a little surprised by your answer when you answered that way earlier, is that this is exactly what I'm doing. Now, I'll say with the caveat that I've been actively trading for about 12 months now, and it's been a really good 12 months. Now, I'll say that the market overall has not been maybe the typical environment over these past 12 months.
Straight up.
So whether or not my current success is sustainable long term is kind of what I'm trying to gauge. But I mean, just to give you kind of some context, over the past 12 months, I've made 70% on the money that I've put in, and I'm analyzing, just straight market data, and along with augmented by some analyst data that I'm scraping. And with those two things alone, it's been
like Estimize or something like that, or
Estimize. I don't even know what that is, so no.
Okay, Estimize is like they were trying to be like a public warehouse of analyst data, something to look at.
Okay. No. So no, I actually have paid subscriptions to a couple of different
real-time stuff.
I'm using IBD ratings and Zacks ratings.
Okay, that's Zacks is one of the really quant. I mean, they're considered a quant firm, right?
Yeah.
I think trying to actually. I mean, I'm not sure how. Really, if you break it down, how much you're making from the Zacks, like all the other data you mentioned, versus market data. I would actually say that the market data that you have, the Zacks and the others are what are helping you.
Okay.
I mean, you tell me. I mean, some of So I didn't even get into concepts.
It's a very strong predictor for sure. It has a really high correlation with the trades that I've made that have been successful. So
I mean, one of the key things, like for metrics, are the amount of risk you're taking.
Yeah,
you don't even know what that is. I guess what I'm trying, and I'm not trying to be, I'm just trying to sort of give you how like a quant might think. You don't actually. I'm surprised no one heard my loud one outside earlier. Many of the some of the other areas that some of these risk model firms also look at the quote attribution. So they look at how. So they have they have basically models to show you how your portfolio is sort of positioned to risk. But then you can look at back and say, oh, well, my portfolio was exposed fully to momentum, and actually, I would argue that much of what's helping you is momentum.
Sure.
Right now, was it momentum? Well, actually, momentum's kind of shaky, but high vol stocks are what it is. If you put, typically, we would actually quote be short vol. We don't want volatile stocks. Guess what do you think is so? And if you plot if you basically were to rank high vol to low vol stocks every month for the last 30 years, and you basically bet on low volatility, you would have rocked. Low volatility is always good, except for last year. Okay? So right. Much of the pain you've been hearing about is because of low vol being just tossed out, and a lot of it is because of the individual investors. Trading sort of differently to how we would think. As I mentioned, our ratings on GameStop were, and we actually had tried a long short fund. We actually closed it last year, mid last year, but we would have been short GameStop. It would have killed us.
Yeah.
But for every good reason, as I mentioned, the financials, blah. Financials sucked. Their conference calls were poor. Their quality of the well, I already mentioned the financials sucked. And every model we had, it was negative. We might not have had a huge short because of the way we manage our portfolio. It would be risk controlled. We wouldn't have been as bad as the Melvin Capital, but it would have hurt. Absolutely, it hurt us. We weren't even short the stock. We just didn't own it. That hurt us enough. And to make that sort of make sense is, we try to manage a portfolio based on a benchmark. So we want to try to beat the benchmark, right? And the portfolio and the benchmark has GameStop as a certain percentage, which has suddenly skyrocketed because of the jump in the stock.
Oh, that's interesting.
No, we don't own it. That's a bet that we've made that it's not going to do well. And that bet 2 weeks ago, one day it hurt us 1.5%, and other stocks. And 1.5%, we should never see 1.5% day ever. We should be, good for us would be 10 basis points a day. If we could get that, we'd be 10 basis points a month. If we got 2.5% a year, that would make us rock stars. But we lost 1.5% in a day.
That is really crazy, but also really good context. Thanks, Warren, for the question.
Sorry. So, God bless you. But yeah, some of the performance you're getting is from momentum. You actually can create a momentum model pretty simply. But a lot of it was you're getting is the last year has been, if you bet in an index fund, like I have most of my money in index funds, skyrocketed, right? After the plunge, after, March, through the roof, right? Yeah. You're gaining a lot of it from that and taking a lot more risk based on the stocks you're taking.
Sure.
So you're doing well right now.
Right.
Don't bet the farm. Don't ever bet the farm.
Really good context, and let's move on to the next question. Oh no! I mean, I agree. If you're in the market right now since March, I mean, if you got it on the low, you made so much money after things hit the wall. Mark came back and had another question. about the difficulty of the statistical math that quants use. Obviously, it's a lot of PhDs, but is it? I'm not sure if he's asking if it's something that's like unlearnable or just like for.
If I can learn it, anyone can. It was tough for me. My math was okay. I was underprepared for my for my master's degree. It was a hard slog. But do you need to know all that kind of stuff? No, you need to know how to use the tools.
And why?
And how you be able to need to use the tools and what the models come up with and why they do the way they do. It's kind of, I guess, sort of the master's degree level. You kind of have to know how to use the tools. The PhD level is you kind of teach, and you got to be able to show those equations on the blackboard.
Yeah, one of the things that we talk about a lot, like even for our classes, like often like that's a question we get where it's like how well do you need to know Python? Like for most people, if you're not a data scientist, if you're like a financial analyst or you're a marketer or whatever, it's like you need to know enough to know what you're asking for, how long it should take, or if you're like, you should know like which models, right, tend to have like a certain kind of outcome, but you don't know how to like write the algo for it, right? Here we go. One more question from Matt. He's asking about modeling. He's asking if it's still worthwhile to learn R in addition to Python. I'd say stick to Python, but I'm curious what you think.
So my colleague, he actually has a background in computer science and then got an MBA. He is mostly still R and learning Python. R is a good solid language. And if you're doing statistical work and if you're doing the research for the models, it's still pretty solid. I think it's something to know. I just moved off into Python because, it was something new to do. And it's a little faster. But I think it's really getting there, and it does a lot of the things that I think R doesn't do as well. As I mentioned, Python's a glue language. You can take everything, you can bring the data in, do whatever you want to it, and spit it out.
It's a much more versatile language. If you want to,
I think so. Yeah. I think so. But R is a good, solid language. I definitely liked it.
I mean, if you're in academia at all, or if you're super stats heavy, then R is what you go with. If you're thinking about doing more than that, you're not sure, Python. If you can do both, I mean, usually my answer is always, why not both? If you can do it, why not?
It's best to know how to program as opposed to know how to program specific things. You can always
learn. Yeah. Google's your friend. Stack Overflow is your friend.
Stack Overflow is your friend. Always. Absolutely.
We have one of our instructors, the thing he always does is like, someone's done this before. Let's go figure out what they've done and copy paste. Which it's not always that simple, but sometimes it's that simple.
For small components, yeah. Sorry.
Oh no, I realized I skipped over Carl. Carl, sorry about that. He asked, what AI algos have you found the most useful for financial modeling?
We have not really done that much quote AI yet. We're sort of looking at some of the basic stuff. As I mentioned, there's the talk about AI and finance. It's like, well, many of these things are, statistical concepts from, they're sometimes basic regressions, but that have been sort of, created and done, a better analysis for. I have to say, we haven't really used anything, quote, AI. They throw natural language processing into that, and some of the sub models from like Spacey and like Vader, for instance, may be considered AI, but we're not really doing that right now.
I have to be honest. I feel like a lot of people who say they are not necessarily doing that.
Yeah, that's what I'm saying. NLP's thrown into that, I think, just to make it easy, because it's an easy concept.
Yeah. Well, also, I feel like when we talk about, like, in the data space, you often hear, like, AI, ML, like, used interchangeably, right? It's not the same thing. And like, I've talked to, just doing what I do, I get to have conversations with really interesting people. And I had someone else who was with a pretty mid-sized U.S. bank, and basically he was like, "Look, we don't need AI for what we're doing." He's like, I mean, it sounds cool, but it's like, I could tell you right now, he was like a director, I forgot his title exactly, but he's like, we talk about it, we don't need it. He's like, so I'm pretty sure those small guys, yeah.
Well, the banks though they're stuck because, a lot of their models they have to have are regulated, and somebody has to go in there and see if, the model does this. And unfortunately, those folks who do the model, I guess, kind of like the due diligence folks, they don't like things where the output could change.
Yeah.
That's just no. Yeah. That's a a flag.
Yeah. Well, then you're also
and unfortunately they're gonna have to know that and gonna have to get there. But the banks don't want. That's just not gonna happen. So to your friend's point, they will never probably go into quote AI or machine learning unless it's like fraud detection. From what I heard, there's detecting certain things using machine learning. Yeah. But could you have done that with a regression? Yeah, you probably could have too.
Well, that's the fun part, right? I mean, sometimes I like what you said earlier. It's like, well, these are my words now. Kind of like a glorified statistician, or it's like you could do a lot of these things with. You don't have to use the fancy tool. Is it a little bit better? Maybe, but can you get there with Excel? Probably. With a lot of questions. I mean, obviously not for what you're doing because you're just the numbers are just so much bigger. But for
we couldn't even come close. Excel, you
would break Excel really quickly.
Today I would have broken Excel. Yeah, it's not even a question. I'm breaking my Python.
Well, that tells you something.
The next thing is Julia, from what I heard, but I don't know anyone programming.
Fair enough. All right, I'm not going to hold you up any longer. This is a really good talk. I've gotten a couple of LinkedIn messages myself for folks who really enjoyed it. So
okay, great. Glad to have talked.
Yep, absolutely. For everyone who's on, I'm going to leave the lounge open so you guys can go back, meet each other, hang out. Let me go ahead and drop our LinkedIn profile. Feel free to connect with us. I'm also going to drop here our YouTube channel. So if anyone wants to rewatch this talk or check out any other ones we've had, feel free to go. Obviously, we'd love a like and a follow, please. That said, we do these every week. It's always top tier practitioners and conversations just like this, like authentic. Ask whatever you want. Right? We're here to learn. We're here to ask questions. And hopefully gain something that we can actually take back and use in our day jobs or whatever else we're doing. So with that said, thanks for coming, everyone, and hope to see you next time. I'll be hanging out a little bit, and then Justin, if you have time, feel free to hang out. Otherwise, no worries.
Sure, I'll stick around for a few.
All right, guys. Thank you.
Thank you, guys.